Investors, though, keeping close tabs, tracking Fed Chair Jerome Powell's testimony in front of Congress for any clues about the timing of rate cuts. And they're also anticipating Thursday's big CPI print, which could help guide the Fed's thinking around cuts. The majority of traders are pricing in a September cut. Our next guest, though, says if we see that first rate cut in September, it will likely be due more to the weakening labor market than the inflation print. Here with more, let's bring in Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Great to have you here with us today, Brian. So take us into your thesis here and why it would actually be more tied to weakening in the labor market versus the inflation print.
Well, to your point, just as the graphic showed before, we're not really getting close to the 2% target that the Fed has set out for a normal inflationary environment. So if that's the case, if rates are going to go down sooner than later, it's morely because the dual mandate comes back into play. Chairman Powell talked about this a couple times in testimony yesterday, where we are seeing more movement in the labor market with the unemployment rate up to 4.1% rather than prices coming down closer to that 2% target. If we just take the Fed at their own word and look at their summary of economic projections, they thought that the peak unemployment rate in 2024 would be 4.0. We're already above that. And if we were to creep up even more to 4.2, that would be the peak unemployment rate in 2025, according to their own tables. So that becomes more of a growing concern for the Fed rather than just prices. So remember, it's full employment and stable prices are the two mandates that they're worried about. And it seems like one is advancing more than the other. And in our opinion, that tends to be weakening in the labor market, at least according to the trend in data right now.
Where do you need to see continued weakening on the inflation part of this equation, especially as we know it's been stickier in things like shelter and energy?
Yeah, exactly. Those are the really sticky things. And I'll throw in healthcare there as well. We have seen material relief in things like used car prices, and that's helping on the headline portion of CPI. But really, it's that shelter component that is so sticky right now. And we've seen kind of rolling waves of food inflation. It's gone from one category, it was meat and poultry a year ago. Now it's in things like cocoa and coffee and things of that nature. So it's been kind of a rolling target trying to get those prices to come down. Every time one category tends to go down, another is moving up to all-time highs just in terms of the pure commodities. And so that's been a difficult moving target for the Fed to try and control. So we need to see relief in other areas to try and counterbalance some of the shortages that we've seen just from the supply side alone on food.
And so additionally here, you're seeing volatility in the back half of the year. For investors trying to price that into their portfolios, what investments, the types of investments, should they be looking for?
Well, what we believe is as we've gotten to about 17% return on the S&P 500, it's a wonderful year. We'd all love to book that right now and call it a day. What a great year, what great returns. But that's really been driven by such few stocks. To your chart earlier, the Magnificent Seven account for the lion's share of that 17% growth in the index. So if that earnings is going to balance out, we feel like it's going to come from higher quality names. It's not going to be a broadening effect across all names because we are still in a very high interest rate environment. And I'm just making the case now that growth is slowing, jobs are weakening. This isn't necessarily the case where you're going to see earnings growth from every corner of this market. So you really have to be concentrated on what we think are the highest quality metrics, things like really good and growing earnings. If the S&P is growing earnings around 7%, then that would be the mark that we want to try and beat. And we want to see that done without using a lot of leverage on your balance sheet. So things like low debt levels, high free cash flow yields, and good and growing earnings, those are going to be the types of companies that will outperform their peers, but they'll also be higher quality names that are better set to handle a more volatile back half of the year. One thing I'd like to point out is just simply the lack of volatility to the downside that we've had. We haven't had a 2% down day in more than a year in the S&P 500. 2022, not all that long ago, the 5 worst days in the market were all 3% down or more. A couple of them were even 4% down. So if you think about it where we are today, that would be a 250 plus move down in terms of points shaved off of the index. I don't think that investors are really ready for something like that. We've been lulled into this false sense of security that this market is just going to keep going up forever. And as we know, most everything reverts back to its mean over time. And that's just simply what we're expecting.